Live from Frankfurt, this is Bloomberg Daybreak Europe. I'm Oliver Crook with your top stories. Oil rises and global stocks fall to a one-month low as the United States launches new strikes in Iran for a second straight day. Markets ask, when is a ceasefire no longer a ceasefire? And tech trauma, Oracle slumps after hours as concerns over data center spending overshadow AI growth. And decision day here in Frankfurt, the ECB set to deliver its first rate increase since 2023, the first major central bank to do so in response to the Iran inflation shock. All that coming up a little bit later today. Let's check in on the markets as we go into the session today. You look at the MSCI Asia Pacific Index down by about 0.33%, off some of the session lows we saw a little bit earlier in the day, following the sort of very negative session we saw in the United States yesterday. NASDAQ selling off about 2%, 1.6% off the S&P yesterday. European stock futures this morning, as you can see, down by about 1% there. And then in the United States, S&P futures gaining a little bit after that sort of big sell-off across American equities all of yesterday across all the major indexes. S&P futures up by 0.4%. If we move it on to Brent and the oil complex this morning, we see that oil climbing as we see those strikes in Iran. Still fairly modest, though. We've only broken just there through $94 a barrel, up by 1%. So there's still some confidence that this ceasefire may still be in effect, despite the strikes we've been seeing on either side. Bloomberg dollar index basically flat this morning. And of course, the U.S. 10-year in focus, borrowing costs in the United States ahead of that Fed decision next week, trying to make sense of all of the inflation data we got this week and yesterday, PPI a little later today, and of course that labor market report last week. As for the risk events, what we're watching a little bit later today, the main event here in Europe, here in Frankfurt, is the ECB rate decision at 1:15 UK time. That will be followed by a press conference from Christine Lagarde about 30 minutes later. But between those two events, we get May PPI from the United States. Producer prices will be in focus. How much of that will be traded down to the consumer, causing inflation? Of course, the big corporate event of the day, the IPO, the pricing of SpaceX, coming a little bit later today. Well, oil rising this morning as the United States carried out strikes against Iran for a second straight day. That's after President Trump accused Tehran of dragging out negotiations.
We hit them hard yesterday, and we're going to hit them again hard today, in case you miss it, in case you don't turn on your television set. And we'll see what happens with the deal. We were really close to a deal, but they keep tapping us along. They keep playing us for suckers because, you know what? They dealt with some very stupid precedents.
To make sense of some of this, let's bring in Bloomberg Horizons anchor Abir Abu Omar. Abir, listen, we're hearing some sort of more encouraging rhetoric from both Iran and the United States, both saying that the strikes are sort of concluded. But at what point is a ceasefire no longer a ceasefire?
I would say at this point this morning, Ollie, that they both have come up with encouraging statements. You're right. But we are seeing these hostilities really pick up pace over the past week or so. Now, the hostilities that we saw overnight and into this morning follow hostilities from yesterday, with the U.S. attacking areas in central Tehran, some water storage tankers in Tehran as well. Iran accusing the United States of not just hitting military targets, but also civilian targets. And this all follows the attack that the U.S. accuses Iran of downing an American helicopter prior in the week. And so yesterday we did assume that it would be a tit-for-tat sort of hostility pickup, but then we saw today happen. And then the Iranian retaliation was carried across countries in the region, including Jordan, including Kuwait as well. And this also happened yesterday. So what we're seeing is, again, this pickup in hostilities. At this point, we thought that the ceasefire negotiations would actually materialize. President Trump has claimed that ceasefire negotiations are underway multiple times over the past couple of months. He actually still maintains that they're imminent, but there are still some sticking points there, Ollie, right? I mean, Lebanon is a big part for Iran, and Israel has continued its incursion in Lebanon. Iran saying that it will not not come back to the negotiating table unless the attacks against the southern part of Lebanon cease. That is not the case. But when we talk about the ceasefire in general, it's been fragile over the past couple of months, to say the least. But this past week or so brings up those prospects of whether it actually will lead to a ceasefire extension for 60 days and the opening of the Strait of Hormuz. It doesn't look like it, but for now, we're right to assume that the hostilities are over for the day. We don't know if they'll pick up. We'll have to wait to see what President Trump wakes up with and whether Iran comes back to the negotiating table.
Well, Abir, thank you very much for keeping up across that. That's Bloomberg's Abir Abu Omar in Dubai. Now let's see how the Asian markets are interpreting everything we've seen overnight with Winnie Su in Hong Kong. Hey, Winnie.
Yeah, good morning, Oliver. It has been a very volatile day in Asia. In fact, we opened actually lower, but then saw that very sharp rebound into the green when that headline of U.S. completing the latest strikes of Iran dropped. And however, that really didn't last for long. The optimism was pretty short-lived. As you can see, that downward momentum soon followed. And that is coming as these uncertainties around the real resolution and also elevated oil prices. Now, we are also very closely watching out for that SpaceX IPO to come. So a bit of a jittery when it comes to the overall market. Now, you flip the board, we take a closer look at some of the key moves in the different benchmarks. We have South Korea's Kospi index here fluctuating, but in fact, it was down as much as 4% earlier today. Now, the rebound is being led by some of these key chip makers, Samsung and SK Hynix. However, when it comes to the Japanese market, still closely watching out for the Japanese yen, which is now hovering around that 160 level against the dollar. Unfortunately, we did hear that Governor Ueda is now hospitalized and will not be able to attend the central bank's decision meeting next week. For now, market is still expecting one rate hike to come. However, they will be very closely monitoring that tone from the deputy governors. Flip the board, we take a look at the Chinese markets. We haven't been talking about it as much just because so much is being dominated by the AI darlings of Taiwan and also South Korea. However, worth flagging some of the milestones for you today. We have MSCI China down 1.5% and just about 1% away from entering the bear territory. And also looking quite grim is the HSCEI here, in fact, is one of the worst performing stock gauges so far this year. We have HSI, in fact, at a 11-month low. Now, today, a lot is being dragged by the downside of Alibaba that we are seeing with these concerns around the AI token pricing after Wall Street Journal reported that OpenAI is considering drastic price cuts. However, that overall underperformance of Hong Kong and China shares really come as they have this lack of AI exposure and also weak earnings. Back to you, Oliver.
Thanks very much, Winnie Su in Hong Kong, for all the market action overnight in Asia. U.S. futures, on the other hand, are pointing higher despite the latest escalation in the Middle East, rebounding from an initial drop in the wake of the U.S. strikes on Iran. Let's bring in Ven Ram, Bloomberg MLive strategist. So listen, Ven, we've got more selling over in the United States. Wall Street, of course, a lot of that was tech-driven. We're getting that coming up a little bit today, and a turnaround in U.S. equities. What's driving sentiment this morning? I don't think that Ven can hear us, judging from the hand gesture that we've seen there from our MLive strategist, Ven Ram. So we'll come back to him in a moment once we reestablish communications. But still ahead, as markets ready for what looks to be a hike from the ECB, we'll discuss the outlook with Carson Bresky over at ING. But first, we'll also be talking about Iran announcing the closure of the Strait of Hormuz after the United States attacks. We'll talk to the logistics with the CEO of DHL Global Forwarding and Freight. That will be next. And this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. U.S. futures are pointing higher this morning despite a latest escalation in the Middle East and that sort of aggressive sell-off we saw yesterday and we've really seen across the tech complex over the last week or so. We'll bring back Ben Ram now, who we've reconnected with, our Bloomberg M Live strategist. So listen, Ben, trying to get an idea of what is really sort of driving market sentiment at this point. Obviously, we've had a lot of stories idiosyncratic in the tech sector. What do you think is driving sentiment this morning?
Morning, Oliver. I think that, the markets are still looking forward to, even though they fell big last night, the markets are still looking forward to the SpaceX IPO, which has been 4 times subscribed. Massive enthusiasm towards that. But you've got to keep in mind that these are coming at stratospheric valuations. So I don't know how sustainable that is. And the markets have come getting to realize that look, this is not going to go up in a straight line, and this is a market that is prone to pitfalls, and especially in terms of valuations, the markets are beginning to realize that we are in frothy territory. I think we got an adequate warning of that last week with Broadcom's disappointing earnings, and I think that was a big turning point for the markets. The markets will stumble through this in fits and starts. We have got the SpaceX IPO. We've got Anthropic and OpenAI also in the pipeline. So until these 3 IPOs are done and dusted, the markets will be go through this phase where they're exuberant 1 minute, the next minute depressed. But I think that, after that, I think the markets will settle into their own orbit. And I think that these overvaluations will eventually correct themselves. So I think that last week was a big turning point for the markets. The markets are realizing that, look, we are now close to the Minsky moment, where valuations have stretched beyond repair, really.
Yeah, and we saw that sort of with the sell-off in the NASDAQ down, I think, 6 or 7% from the peak that we got last week. Something else we're watching very closely, Ven, today is, of course, the ECB rate decision, expecting that first rate hike since in almost 3 years from the European Central Bank. There is total consensus that it's going to happen. Is there total consensus, Ven, that it's actually a good idea for these rates to come up here in Europe?
Well, I think that the markets are priced for, more than 2 hikes. Really, they're zeroing in on 3 rate hikes. One interesting part of the equation, Ollie, is if you look at the euro has tumbled since the war, and that is basically reflecting the terms of trade shock. And I think that the ECB is going to revise down the growth estimate for this year for the Eurozone. And I think that will impinge adversely on the euro's fortunes. But I think that they are doing a good job in terms of controlling inflation, because they are projecting inflation under the adverse scenario to come in at 3.6%. This is a central bank, unlike many others, Ollie, which means when it says 2% inflation, they mean 2% inflation. They don't mean 3% or 3.5% tolerance that we have seen probably with the Fed and the Europeans and the Bank of England as well. So I think that inflation is going to be under control. That should send a message of confidence to the bondholders in Germany.
Yes, indeed. But the question is there going to be too much of an impact on growth? And I think that'll be the very lively debate for the weeks and the months to come. Ben Ram, the M Live strategist, joining us there this morning. Thank you very much. And Iran has halted the Strait of Hormuz shipping in response to fresh U.S. strikes, while the U.S. military disputes the full closure of the waterway. The World Container Index rates for 40-foot containers jumped 23% last week, surpassing the $3,000 mark for the first time in a year. Joining us to shed a bit of insight from Amsterdam is the CEO of DHL Global Forwarding, Oscar de Bach. Oscar, thank you so much for joining this morning. I'd like to begin just by getting your assessment of where we are, where shipping rates are going, and your assessment of this war now that we have been in for a very, I think longer than most people would have liked.
Yeah, I think as we've seen, this uncertainty will stay on for longer, and also what you've seen what recently now happened again with the Strait of Hormuz and the whole Red Sea road will continue to have its impact on the capacity overall in ocean freight, as you showed earlier. That's why you see the impact on rates over there. So we have to continue to help our customers to use the alternative route, which has been used now for quite a while already, and I think that situation will continue.
And how is that bearing on demand more broadly? Obviously, you're finding alternatives. How do you see the demand picture holding up globally?
Well, demand is actually holding up, absolutely. So the volumes are there, both on ocean and on air side. So the key thing is to make sure that we find for our customers the most convenient routes that still meets their customer requirements on the one hand, keeps the cost within control, but also takes in consideration what's there to come. Because I think we have to continuously stay prepared and be agile on what's there for the next day to come. So that is the alternative routes, the direct routes, both on air, on ocean, the going around there, making sure that we also help our customers to then we take alternative routes, that we stay in line with regulations, customs clearance, all of those, all the trade compliance elements that there are at the moment. So we sort of describe it that we have to be the lighthouse for our customers in the continuous storm that we're in, and there's no sight of a weather forecast that this storm will end near soon.
Well, I wanted to try to get a sort of forecast from you because obviously this is very dependent on the sort of political developments, but I suspect there's also a lot going on in the background in your world that maybe even if after a resolution there are going to be some enduring effect on freight rates. What do you think the enduring effect on freight rates will be, sort of irrespective of the politics here?
Yeah, what the effect on, I mean, the element of, so when you look at air, the element of scarcity is there at the moment, and that will take some time for itself to recover and to normalize again. And you'll see a similar thing on ocean freight. I don't think it will be a one-day solution. This will gradually have to resolve itself. Even if one day the Suez Canal will be fully used again. Also, that will be something that will phase in, because let's not forget that will save about 10 days of the total route. You can't suddenly bump that into all the various ports, because then you get port congestion and then you get a problem there as well. So that has to phase itself as well. So just as it operationally will have to phase, I think you'll see a similar thing on the rates.
And thinking also about the sort of different scenarios that you're considering, and again, there must be a very vast sort of array of them that you're considering. For the Strait of Hormuz, obviously there's the full closure, there's the full reopening, there's something in between, the toll system. What are the kinds of scenarios that you're sort of anticipating or even playing with in terms of trying to assess what this is going to look like in the future?
I think you said it really right, is that we have to work with scenario planning, right? That's the only way to manage this through. Actually, we do the scenario planning per customer to see what's relevant for them. For many, it's more the stability around the Red Sea, around the Suez Canal, which is the bigger impact when we talk about the real flow of goods. But obviously, when we talk about the availability of fuel, that's another story, right? Then we talk more about Strait of Hormuz and then how that will evolve. We make sure that because we got our own airlines, so we got our own control of how we manage fuel. So we got that pretty much under control together with our suppliers, because that's going to be crucial. When you talk about scenario planning, that scenario, of course, you want to make sure that's well under control. And then the other scenarios, indeed, is about how do you phase in whenever the situation stabilizes. When do you start to indeed have the route through the Suez Canal again? What does that do to overall supply chain planning? What does that do to availability of goods? So when we talk about scenario planning, honestly, the political part I leave to others, but the supply chain element and the overall planning we do together with our customers, where we look at different scenarios and always make sure that we have alternative routes for whatever is there to come. Because I think one thing that we all learned together over the past, I would say by now 5 years, is that there's always something unexpected around the corner. And that means that the way we do the planning with our customers, you have a base scenario and you have a second and a third, so that we can fast act when things happen together with our customers.
And another sort of important forecasting that the markets are trying to get around is, of course, the ECB raising rates. Do you have any concerns about rates rising in Europe and what that is going to do to demand and what the outlook is going to look like as a consequence of that?
We see at the moment, volumes are actually holding up, as I mentioned earlier. What that's going to do at the future, I think that's probably more the question you should ask to the previous guest than to me. I can tell you what the impact would be then on the overall supply chain of that. But overall, from what I see at the moment and the interactions with our global customers, is actually pretty confident.
Well, you run obviously a German company. You are yourself, of course, Dutch. I'm going to put you on the spot here. The World Cup kicks off today. What are you expecting?
Yeah, I'm originally Dutch, so my hopes are obviously on the Dutch team. But I think France, Spain is probably where we have to bet on.
Well, there you go. Getting all the forecasts from the CEO of DHL Global Forwarding, Oscar de Bach, joining us today from Amsterdam. Thank you very much for your time. Coming up, Oracle slumps after hours on worries about soaring capital expenditure. Details next, and this is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Oracle slumping over 10% in after-hours trading after the tech company reported quarterly capital expenses higher than anticipated, largely related to data center build-out. The spending is raising investor concern over the profitability of AI infrastructure. And I'm joined now by Bloomberg senior strategist Neil Campling. Talk us through these numbers. Is this something that we're expecting to see more widely across some of these tech names? A little bit of skepticism coming into that tech trade.
Yeah, it's a kind of microcosm of the AI debate actually within these earnings. On the one hand, you had very strong revenue growth coming through in the results, but on the other hand, you've got this acceleration of spend that they pointed to. A ratio that's often talked about is capex to sales, and they are suggesting it could get to as high as 100% in the next fiscal year, which is a very, very high number. And it's not really coming through in the top line growth yet because they forecast sales for the following year pretty much in line with where the street were expecting. So the stock had rallied 50% from recent lows in April into this print. So a 10% kind of rebalancing reaction is not really a big surprise to see in the aftermarket hours. But that debate is definitely going to continue from here.
Yeah, and of course, technology in focus, not just because of the sell-off we've seen over the last couple of days. You know, NASDAQ down, I think, 6 or 7% from the highs from last week. But of course, the IPO pipeline, which has got a huge amount of investor interest. We've got SpaceX pricing a little bit later today, Anthropic, OpenAI. Connect all of these stories for us. This is an interesting time to be sort of selling into this. And of course, the euphoria does not seem to be diminishing, particularly for SpaceX.
Yeah, SpaceX, as we reported last night, obviously, there's more than 4 times oversubscribed. And we have to put in context, this is the largest IPO deal ever. So it's a big number in terms of the absolute pipeline of that for sure. So we're coming to the market now. Some people, like veterans like Jim Chanos, is saying that it's really the retail appetite for this trade that's creating much of the hype around this in the short term. But as you mentioned, coming further down the pipe as well, we're going to see some interest in terms of Anthropic and OpenAI as that battle for the leadership really in the next generation AI infrastructure comes to the market.
Yeah, and thinking sort of also about some of the other inputs in these tech names. Of course, a lot of these models have not been fully tested in terms of the long-term business model. Now getting some reports from the Wall Street Journal overnight that OpenAI adjusting some of its pricing. Take us through that very quickly.
Yeah, this is a fascinating thing. We heard from Uber last week they were capping the use of certain AI tools because it becomes so expensive. OpenAI, by suggesting they might lower the cost of the tools, is reflective of, one, because the costs are so high, secondly, trying to get usage higher up, and third, because they're facing massive competition from Anthropic, who have really come for massive acceleration where they are today to probably lead OpenAI in terms of growth and positioning right now.
Yeah, well, thank you very much, Neil Campling, for your perspective on all those important stories. Watching, obviously, very closely the pricing of the SpaceX IPO a little bit later today. Well, coming up on this program, the ECB set to raise interest rates for the first time since 2023. We'll discuss the European outlook with Carsten Bresky of ING. That will be next. Of course, we're watching the markets going into the session today, selling off a little bit in European equity futures. That follows a very down day over in the United States, where stocks sold off in the NASDAQ by about 2%, about 1.5%. Over in the S&P, rebounding in the United States a little bit, but of course, watching all the asset classes going into that all-important rate decision from the ECB at 2:15 Frankfurt time, followed by that press conference from Christine Lagarde. Where does she see the stagflationary risk in Europe? That will be the big question, and we'll get it a little bit later. This is Bloomberg. Live from Frankfurt, this is Bloomberg Daybreak Europe. I'm Oliver Crook with your top stories. Oil rises and global stocks fall to a one-month low as the U.S. launches new strikes in Iran for a second straight day. Markets ask, when is a ceasefire no longer a ceasefire? And tech trauma, Oracle slumps after hours as concerns over data spending overshadow the AI growth story. And decision day here in Frankfurt, the ECB set to deliver its first rate increase since 2023, the first major central bank to do so in response to the Iran inflation shock. Looking at the markets this morning, MSCI Asia Pacific Index this morning trading lower by about 0.6%. You can see it there. 26.3 is what we're looking at in the trade intraday session. European stocks following the lead over in Asia, down by 0.5%. And of course, S&P rebounding a little bit after what we saw, that pretty big sell-off across American equities yesterday, up this morning about 0.4%. So looking elsewhere in the market, looking at the oil market, we have seen a bid for oil this morning, Brent rising by about 1%, breaking through $93 a barrel. The U.S. dollar index, Bloomberg dollar index, basically dead flat this morning. Of course, the U.S. 10-year yield more or less flat, down by about 1 basis point, really trying to assess all of that data we're getting out of the United States, whether it's that CPI data we got yesterday, that strong labor report, and obviously a lot of anticipation ahead of that rate decision next week from Kevin Warsh, the new Fed chair, which we'll be following very closely next week. Let's get now to the front page news across the world this morning. The Financial Times leads with the latest U.S. strike on Iran, describing them as an attempt from President Trump to force Tehran into a deal. The president, of course, been very objecting to the pace of negotiations. The Wall Street Journal reports that ChatGPT maker OpenAI is considering drastic price cuts as it looks to win customers from rival Anthropic, with IPOs expected for both of those companies a little bit later this year. And here in Germany, Handelsblatt describes concerns from companies and experts who say that the biggest wave of cost pressures from the Iran war could still be to come for the country. That is a conversation we'll get into very, very shortly. And you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers go to DAYB Go. Well, here in Frankfurt, the ECB is set to raise interest rates for the first time since 2023 as the upswing in inflation caused by the Iran war becomes impossible to ignore. The hike, if it happens, will make the ECB the first major central bank to increase rates in response to the conflict. I'm very pleased to be joined now by Carsten Bresky, head of research, macro research over at ING from Frankfurt. So thank you so much for joining us on set this morning. Obviously, the market is very confident about what we're going to get for the ECB. Do you think that that is the correct thing? Is that what the ECB should be doing?
Well, given the past of the ECB and clearly the fact that in 2022 they were far too late to react, yes, it's the best thing they can do. But call this an insurance rate hike. An insurance rate hike to ensure the credibility, the inflation fighter reputation of the ECB. And I think that's what they're going to do. Does the economy really need a rate hike? Now, we know this story. A rate hike will not end the war in the Middle East. A rate hike will not bring down oil prices. So not necessarily, but the ECB burned their fingers in 2022 by calling an inflation shock transitory for too long.
Right, but then of course there was the other sort of concern, the other sort of great trauma of the ECB, which is 2011, which was prematurely hiking, bringing down sort of growth and then having to sort of capitulate. We were speaking to some guests, for example, Jeff Yu at BNYD, saying that basically if they raise this week, they're going to have to cut again in the fourth quarter. What do you think the impact is going to be on growth, and do you think that that might put them in an uncomfortable spot?
I think 25 basis points won't make a difference between strong growth and a recession. If they go beyond today's rate hike, that's obviously putting more pressure. And indeed, I'm fully with you. I think that the comparison with 2011 is much more justified than with 2022, because we're not seeing really a big inflationary wave. So there is a first wave this year, but we won't get the second and third round effects. So indeed, if they go beyond the first rate hike, then there is a high risk that they would have to cut again towards the end of this year or early next year.
So is your base case one and done, that this is not really a cycle, this is just about sending a message, and hopefully they're doing it early so they don't have to worry about it later?
Well, if I was in the chair of Christina Lagarde, it would be my base case, but I'm supposed to predict what they're going to do, and I'm a bit afraid that they want to do a second rate hike as well, so maybe even a meeting by meeting, so already going a second time in the July meeting. and then they would have to correct it towards the end of the year, early in 2027.
As you say, 25 basis points is not very dramatic. I think we get very excited because it's the first rate hike in quite a while. But, this obviously will have a huge effect. I mean, a wide effect, let's say. And I think that one of the things that's sort of interesting to me is we have not talked about debt levels in Europe in a little bit of a while. This is sort of in the back burner. When does debt become a sort of more serious conversation, particularly when you see the cost of servicing that debt rising?
Well, it should become a discussion because some countries already are moving in a direction where they will have to pay like 5% of GDP just on interest rate payments. So that is an enormous pressure, a bit like in the US. And of course, we already had now the European Commission try of relaxing the rules again for fiscal stimulus, tackling the energy crisis. So clearly, we are in a high debt environment. Bond markets have priced in quite a lot already in terms of ECB rate hikes. So I think they priced in 3 rate hikes. And indeed, so the pressure on governments with these ECB rate hikes will be an important factor. Also meaning, Oliver, that in the end, the ECB will not be able to hike as aggressively as markets think they will, because it would be adverse for growth and it would also be clearly adverse for public finances.
Yeah, and I guess there's also an argument that it keeps a little bit of dry powder because there's a lot of other things in the market. And I think that it's very easy to sort of establish quite a bearish case. Obviously, there's the very bullish case on AI. There's questions, though, about interest rates increasing, the fact that there's not really the fiscal space there in a lot of European governments, and that if you get a sort of unwind of that AI trade with all of the things that we've seen across the world, and we see inflation rising, high energy costs, that something quite untidy could happen quite quickly. Do you think we're prepared for that? And do you think, where does that go on sort of your risk radar of that possibility?
I think we've heard a lot of warnings against it, also coming from the ECB, IMF, OECD, so the warnings are clearly there. But are we really prepared for it? No, but are we ever prepared really for a kind of unwarranted, turbulent correction in markets? No, we're never. But I think that is a good point. So that is actually the reason why the ECB should not hike aggressively, because the comparison with 2011 holds. In 2011, there was an exogenous shock that the ECB underestimated, and the same could happen right now.
Yeah, and I just have another question for you, because we did hear from PIPCO overnight saying that we might be entering a credit loss cycle, that effectively the default cycle is reasserting itself, where they expect significantly higher losses and lower quality credit. Still, spreads are still very tight in terms of the credit complex, particularly with sovereigns. Is that something that concerns? Is that something we need to be paying attention to in Europe?
We should, but at the same time, we also have so much need for private investments in Europe to get this economy going. So it's not only the public sector, so that there is also these investment needs should actually mean that I don't think that the spreads will really widen significantly.
All right. Well, Carsten Bresky, stay there because we're going to come back to you. But ahead of next week's G7 Leaders Summit, Bloomberg has been speaking to policymakers and investors around Europe and its path ahead. This is new Bloomberg's economics analysis underlines why major change is needed. Bloomberg radio anchor Stephen Carroll joins us now for more on this, having done a lot of research and a lot of digging on this. Stephen, is there finally cause for optimism within Europe now?
There is. There are small but significant changes happening that are pushing towards deeper Europe integration, and that is part of the conversations that we've been having with those policymakers and investors ahead of next week's G7 Leaders Summit. If you look at things like the defence loan programme SAFE, the move towards more joint procurement in the defence space, we've got 6 countries, the 6 largest economies in the EU, finally agreeing to move forward with the Capital Markets Union, a long-running project that many really had run out of patience with the implementation on as well. And then if you look at things like competition rules, the EU revising those rules, and we're seeing businesses already noticing those signals coming from Brussels as well. Look at the raft of announcements we've had in the M&A space in telecoms from France and from Italy in just the past week on that front too. So individually, we are seeing these changes being made, these moves towards greater integration, some of the way towards the recommendations that were made almost 2 years ago in that report from Mario Draghi, who said that it was existential for the EU to be able to do more together and massively invest. So they might look like small steps, but something the former EU Commissioner Margrethe Vestager told me for part of the reporting for this project is that it is signs that Europe could be ready to take a leap of faith.
I think it's really important for Europe to realize this is not a race to be more Chinese or more American. This is a race for Europe to be a much better version of herself, and being that, also being more competitive, more focused.
something that Margrethe Vestager mentioned in that conversation as well, is the new impetus that came from Donald Trump's comments about annexing Greenland earlier this year as well, seeing that as a moment again where Europe's deciding to stop appeasing Donald Trump's whims and move towards perhaps adapting to some of their own underlying issues around things like competitiveness. And that new Bloomberg economics analysis acknowledges the size of this problem as well, saying that without reforms, the EU's output gap with the US could double by 2040 to 7 trillion euros. But the flip case is, if they were to go further and adopt more of what's in Mario Draghi's reports, we could see the paths of the European and American economies converge, and at least to stop that decline or that widening gap between them.
Yeah, and Stephen, when we're usually sort of there sitting in Brussels and talking to people, I think everybody seems to have the sort of same analysis of the problems. Of course, getting the things done is the great complication, the great difficulty. What additional hurdles are still lying in the path ahead?
Look, you need to look at some upcoming events to see where the problems may lie. The EU's 7-year budget negotiation going to be heating up in the coming months as well. A key question in that is about whether or not there could be an agreement on more joint debt. That's something that Mario Draghi recommends as part of his report to ramp up investment as well. The politics, as we know, across the European Union can be messy. You've got 27 member countries. You'll be thinking about the idea of how those national interests are going to play into the global or the more European picture as well. And there's the question of the French presidential election next year, for example, could see a change of leadership in one of the largest economies in the euro area, and that could scupper some of those efforts to move ahead in a smaller group too. So that's a potential risk out there as well. Then there's the question of artificial intelligence. Bloomberg Economics weren't able to parse, I suppose, what effect AI could have on this trajectory, because we don't fully know what it's going to look like down the line for economies as well. So that's another risk factor that could see, depending on how it's adopted, the US move further away, or perhaps those two paths move closer together between the European Union and the United States.
Well, Bloomberg's Stephen Carroll joining us from Brussels. Thank you very much for your time this morning. Want to get another comment from Carson Bresky here from ING. So listen, we've talked about it for a very long time, European integration, capital markets union. Do you think that this is now, is there actually a reason to believe that this will have a material step forward and an effect, and a material effect on the economy, or is this more of the same, do you think?
It is moving. I think that's the positive thing. The irony, of course, is this is now almost 2 years after the Draghi report, and we still celebrate as if finally Europe is getting going. So yes, the direction is correct. It's moving a little bit. We're still far from really having then tangible outcomes. Let's not forget that. But this is Europe. And then just to throw in
not for long.
a famous statement by Jean-Claude Juncker, I think during the Euro crisis, when he said everyone in Europe knows what to do. Only European leaders don't know how they will be re-elected if they did what has to be done. And this is the ever reoccurring theme in Europe. So yes, we're moving. We're still looking for this real new business model. We're still falling behind AI. We still need to find how will the European industry actually survive in competition with China. All these issues, but we're moving.
So then there's the question of doing the thing, and then there's the question of the thing itself. So let's talk, for example, about the capital markets union, right? And so this is sort of being treated as quite low-hanging fruit, as almost a kind of silver bullet that is going to unleash potentially trillions of euros of investment. I mean, I'd like to just sort of attack that thesis for a moment. Do you really think that that is the kind of investment, that is the kind of consequence you would get from a capital markets union? It's not as if it's impossible to invest across borders in Europe at the moment.
Now, that is the whole thing. So I think this has become such a huge castle, and a dream castle, that even if it's going to be implemented, it's not going to have this huge impact on the economy, because you're fully right. So it is this idea of getting the savings. So the idea is good. We have a lot of savings in Europe that we don't get at work, but they are looking for yield elsewhere. So, but Europe also needs to offer actually the investment opportunities. If Europe has those, then of course all the savings can be used in a more efficient way also to invest in the real economy.
And Carson, we have to get probably your most important forecast of the day, and it's nothing to do with the ECB or Europe, but it has to do with the World Cup, obviously kicking off today. What are you anticipating? What do you think the final is going to be?
Well, of course, as a German, I hope that Germany will make it into the final, hoping that this will bring some distraction from the lack of economic reforms in the country. I'm a bit afraid that it's not going to happen, and this will be the last illusion, the last dream that Germany also will have to put aside, and then focus all the energy on getting finally these economic reforms done.
Okay, so potentially there, the silver lining from Germany losing in the World Cup. It'll finally have to get its act together economically and policy-wise. Carsten Bresky, thank you so much, Global Head of Macro Research at ING, joining us this morning in Frankfurt. And we'll have full coverage of the ECB policy decision at 1:15 London time, 2:15 here in Frankfurt, followed by a press conference about 30 minutes after that. And coming up on this program, the closure of the Strait of Hormuz and some of the issues that are disrupting oil flows is sending jet fuel prices soaring. We'll preview earnings from the European airline Wizz Air next, and that this is Bloomberg.
We're now forecasting lower growth, principally as a result of the negative impact in the Gulf.
We start to see futures in jet fuel go down, right? It's going to take longer. It's not going to be quick, right? But things are coming back on track.
Supply will get very tight because it's been impacted by the crude supply and then by refining capacity.
If the fuel significantly spikes, we're going to have to raise ticket prices to compensate for that.
Time will tell. It depends on what's happening with the economy, what happens with oil prices.
Those are the airline executives speaking to us at the sidelines of the IATA annual general meeting, warning that the Gulf conflict is tightening jet fuel supply and dampening growth forecasts. And that is, of course, the backdrop that sets us up for the budget airline Wizz Air, which reports full-year earnings in about 12 minutes' time. Let's bring in Conroy Gaynor from Bloomberg Intelligence. So set us up, Conroy. Tell us, what are we expecting this morning from Wizz Air?
Yep, thanks for having me on the show. So, look, we know that Wizz Air was in a difficult spot even before the war in dealing with some of the cost inflation elements, mainly from grounded planes, but also some of the areas such as maintenance was very inflationary for Wizz. Now, we have had a couple of updates from Wizz since the Iran war began. Essentially, we know that they had a higher fuel cost to deal with in March, which is when their fiscal year ends. We know that there was some costs associated with stopping services in the Middle East. But we also heard that maybe the yields came in a little bit stronger as well. So we're kind of as we were. We always felt that Wizz Air may struggle to make a profit in fiscal 2026. And I think maybe they'll end up around the break-even mark as per their guidance. Now, I would caveat that by saying that Wizz Air has been doing significant sale and leasebacks and booking the profit of that on their books now. So, you know, you may want to strip that out, and if you strip that out operationally, it still looks like they're loss-making. Now, that brings us to the outlook for fiscal 2027, the year ending March 2027. I would expect those losses to worsen because, as we know, the cost of jet fuel remains high. Those hedges are going to begin to about 70% hedged for the summer. Those will roll off beyond the summer. I think about 55% for the year as a whole. And with 20% capacity growth, it may be hard to actually pass on some of those extra fuel costs.
And of course, you know, Wizz Air is dealing with this, but they're not the only airline dealing with this. Everybody in the industry is dealing with these issues of jet fuel. How are the other airlines counteracting some of these surging prices? And of course, as you mentioned, that hedging, if that runs out at a certain point, is that going to cause, a severe problem across the industry?
Yeah, well, look, I mean, Wizz's closest peer, Ryanair, has a better hedging position up until March 2027 than Wizz. So there's some advantage there. But yeah, you're right. As we go beyond the summer, I would say most airlines are around about the 70% mark in terms of hedging for summer in Europe. As we go beyond the summer, look, those fuel prices, it looks like they're going to remain elevated. We don't know what will happen beyond 4Q, but it's very hard to see a situation now where fuel prices aren't going to remain elevated versus pre-war prices for the remainder of this calendar year. So there'll be more and more pressure to pass on costs as we go further into the year, into that winter period where there's less demand anyway.
Well, Conroy Gaynor, thank you so much from Bloomberg Intelligence there, setting us up for those Wizz Air earnings out in just a few minutes. And also don't miss our conversation with the CEO of Wizz Air. That'll be at 7:10 UK time, 8:10 Frankfurt time on the opening trade. And of course, the other main event of the day is the World Cup. It kicks off later today with Mexico hosting South Africa in the opening match. But beyond sport, travel, and hospitality, it is, of course, also a major competition for the sports retailers, including Nike. Bloomberg Originals takes a look at the company's turnaround strategy that has been struggling ahead of the tournament despite the return of CEO Elliott Hill.
For decades, Nike had the simplest advice in sports: just do it. But the company that turned confidence into a slogan is now stuck explaining why its comeback is taking so long.
Nike hired this new CEO, Elliott Hill, who had been an executive at Nike for decades, and he was completely beloved by employees. But even under Hill, who has had so much expertise with the company, Nike is still really struggling. Before Elliott Hill took over Nike, Nike was being run by John Donahoe. Nike prioritized its direct-to-consumer channels. So it pulled out of a lot of those retailers. It really strained some of those relationships. Shelf space opened up in those retailers, and newcomers like On and Hoka filled those shelf spaces and really took over some of that running market share. Under Hill, Nike has really focused on regaining its dominance in sports, rebuilt relationships with a lot of the retailers. The running business has seen growth again. Nike is getting back on track in North America, but other parts of the business are still really struggling. Nike's China business continues to show decline. Its Converse business has reached a decade low.
With arguably the world's biggest sporting event on the horizon, Nike will have another chance to prove itself, though its first attempts have been wide of the goal.
Nike released their World Cup jerseys. People started to notice that these jerseys had a major flaw. The shoulder of the jersey kind of puckered up, both on players and with fans. June is going to be a huge month for Nike. The World Cup begins in North America, and the company shares its next quarter results.
For more on that and to watch the full piece, you can watch it on Bloomberg.com/video for many more, also other content from Bloomberg Originals for across the network, and of course across a vast many different topics. Plenty more coming up on the show. This is Bloomberg. In a competitive news day for all the things we're watching today, the SpaceX IPO, the ECB rate decision, we've got to end on the Knicks, really the biggest comeback in NBA Finals history. Now the Knicks leading the Spurs 3-1. It has had an impact on Madison Garden shares. You can see it there on the chart. Shares of Madison Square Garden are up 50% so far this year as it's setting up the stocks for the venue for the best annual performance ever. Of course, we'll be watching that and many things ahead. Of course, the ECB decision a little later today.